This video covers 5 must-know subjects 50% candidates got it wrong. Forecast objects, principles, and approaches. Question 5. Correct answer, B. When forecasting, it's important to use forecast objects that are either 1. Shared regularly or 2. Easily figured out from regularly shared info. The company only shares the total revenue and annual cases sold. They don't break down revenue by where it comes from. So, if you try to forecast revenue for 5 different areas, you're adding pieces that might not hold up when you see the real numbers. Verification is super important because analysts need to check how well their models are doing by seeing how their predictions stack up against what actually happened. If we don't know the numbers for each region, it's tough to figure out which part of the regional forecast might have gone wrong. Even if the whole forecast matches the actual revenue, the analyst still can't be sure it's all spot on when you look at each region separately. Analysts cannot pinpoint the source of inaccuracies when forecasts deviate from actual results. It's unclear whether volume, price, or both forecasts were inaccurate. The lack of clarity surrounding forecast inaccuracies hinders transparency and auditability. A. Incorrect. Management guidance can be incorporated at the total level, and analysts may allocate guidance to internal forecast objects. C. Incorrect. Bottom-up forecasting is valid, and analysts often use both top-down and bottom-up methods for cross-checking. Non-disclosure of objects leads to unverified forecasts, lower transparency, weaker audit trails, and potential inefficiencies. Question 4. Correct answer, B. Management guidance is most trustworthy when the forecast is mainly shaped by decisions made within the company and is something managers can manage. The company's effective tax rate is figured out through internal tax planning, choices about how the company raises money, where the company earns its money, and the laws in different places that affect what can be deducted and what can be credited. These things aren't easy for outside analysts to see, so management has the best information. The effective tax rate is really shaped by the decisions made by management. Management might be able to predict this better than outside experts. If the goal is something within the company that they can control, then management's advice is usually spot on. But if the goal is something outside the company, like the economy, then management's advice might not be as reliable. A. Incorrect. Commodity prices are influenced by global supply-demand, geopolitical instability, OPEC policy, production disruptions, and currency dynamics. Analyst and management forecasts are equally speculative. C. Incorrect. Global GDP estimates are based on external datasets, not corporate guidance. Internal variables are more reliable for management forecasts, while external variables are better suited for analyst forecasting. Internal variables with strong guidance include depreciation, capital expenditures, and membership fees. External variables with weak guidance include inflation, interest rates, and commodity prices. Question 3. Correct answer, B. When management gives a range like 4.50 to 5.00, the curriculum suggests that. The lower end is usually a bit cautious. The higher end usually matches what management thinks they're aiming for. Analysts check their own predictions against the guidance range to see if they're on the same page. The analyst's forecast is set at 4.95. The guidance range is between 4.50 and 5.00. The upper boundary is 5.00. The midpoint is calculated as 4.50 plus 5.00 divided by 2, which equals 4.75. Since the forecast is 4.95, it's a bit close to the upper boundary and not exactly at the midpoint. Management is planning for an EPS that's a bit closer to 4.95, so they've set the lower bound at 4.50 to give them room to report results that exceed the guidance. A. Incorrect. A forecast of 4.95 is reasonable and not excessively optimistic, as it is below the 5.00 threshold and aligns with internal expectations. C. Incorrect. Forecast above midpoint suggests midpoint is not the true expectation. Independent forecasts near the midpoint indicate analyst alignment, while forecasts near the upper bound suggest management's true expectations are higher. Question 2. Correct answer, B. The key here is figuring out which forecasting method isn't the best fit when a company's revenue structure changes dramatically. For example, the revenue mix shifted from all physical retail to 60% physical and 40% online. The historical results approach relies on things staying the same, but that's no longer the case. The historical results approach assumes that what happened in the past will happen again. Before the company bought the other one, its revenue growth mainly came from how well its physical stores were doing. Now that the company makes more than 40% of its money online, relying on past trends misses out on important new ways to make money. So the historical results don't really match up with how the company is doing right now. A. Incorrect. Benchmarking against comparable omni-channel companies and peer-based convergence are valid methods for transitioning into a similar category or maturing business model. C. Incorrect. Analysts' discretionary forecast models each segment separately, accommodating different growth rates, margins, and economics. Stable business models yield acceptable historical results, while structurally changed models yield weak results. Question 1. Correct answer, B. When it comes to forecasting costs within the company, management guidance is the way to go. For external costs that are influenced by the economy, analysts bring their expertise to the table. Lease payments and labor contracts are set in stone and depend on internal policies. Management knows these costs inside out because they're in charge of the contract details and who works there. Jet fuel prices are like a snapshot of what's happening in the market, so we need to use models that look at market trends. Analysts are usually the best at predicting how much the price of jet fuel might change. A. Incorrect. Management lacks forecasting advantage on fuel prices due to global oil market ties. C. Incorrect. Ignoring internal information and forecasting leases and labor independently risks estimation errors. Management guidance is used for controllable or contractual cost objects, while analyst discretion is used for external, macroeconomic, or commodity-based cost objects.